If you happen to be a first-time homebuyer or an investor in today's housing market, you have probably wondered what has happened to all of the affordable housing and the cash flow, because something is definitely changing here in the housing market. In today's video, we're going to break some of that down here based on data. In addition to that, I'm going to share a personal story with a property that I looked at recently that I think you guys will find really interesting. So you'll want to stay tuned for that. The first slide up on the screen, this is data according to Redfin, and this is a testament to where we are exactly in today's housing market. They're actually saying that the share of homes that are worth at least $1 million or higher is sitting at 8.2%. So it's nearly 1 in 10 homes are worth $1 million. So the share of homes that are worth $1 million has jumped up dramatically. In fact, to the tune of about 100% in just a few short years. You can see on this chart here that back in 2019, the share of homes worth $1 million was sitting at about 4%. So it's doubled in just 4 short years. And of course, a lot of this price growth was fueled by endless amounts of stimulus and interest rates being at all-time record lows. Now, of course, the market has shifted and mortgage rates have gone up, and we'll touch on that here in a second. But one could argue that the leading cause for home prices remaining elevated right now, as you can see that they came down and they've gotten back up a little bit, is that we are severely supply constrained. Again, more data from Redfin, but active listings are actually down about 18% year on year. And this is typically not what you see going into these summer months. In fact, you generally would see a pop in inventory. Well, the homes for sale really never showed up this year. In fact, if you look at that orange line, you can see that housing inventory has remained relatively stable all year. We never saw that seasonal spike. And this most likely could be attributed to the unintended consequences coming from the rise in mortgage rates. At the time of this recording, the average 30-year fixed is sitting at 7.26% for your conventional loan. Now, that's the highest mortgage rates have been in a long time. In fact, if we zoom out and we look at this chart here, this is the average 30-year fixed dating back to 1971. If we were to draw an imaginary line here, we can see that mortgage rates are the highest they have been in about 20 years. Now, this is causing many buyers to sit on the sidelines or get out of the home buying game altogether. But I think one of the unintended consequences that nobody could have really planned for is that it's causing sellers to sit on the sidelines as well, because no seller wants to trade their 3% rate for a 7% rate. The real question becomes is, what does this actually do to the monthly mortgage payment? I think roughly 70% of all home buyers use financing. So what does this equate to on a monthly basis? If we take a look here, I plugged in a few different scenarios and I'll run through them very quickly. We're looking at the median home price, let's say around $400,000, give or take. If we look at a 20% down with today's rate at 7.25, we factor for taxes and insurance, a potential home buyer would be looking at a mortgage payment of $2,732. But here's the thing, is that most home buyers are not coming in with 20% down. That's $80,000, and that is not even addressing the closing costs associated with the transaction as well. So a more common scenario might be 5% down. And if we take a look at the same scenario with 5% down, we'd be looking at a monthly mortgage payment of $3,300 per month. Now, to put things into context, in order to qualify for a $3,300 mortgage, the borrower or borrowers, if you're looking at a household, would need to have roughly $90,000 a year in income, and that's assuming there are no other debts. So no credit cards, car payments, student loans, just the mortgage. But of course, the challenge overall is that the median household income in the United States is sitting at $70,000 per year. So there's about a $20,000 gap, and of course, we're not accounting for other debts. And so what's happened in many cases is that home prices have become significantly detached from the local wages. Now, not to be completely doom and gloom here, but the sentiment in the housing market has changed as well. In fact, according to a recent survey provided by Fannie Mae, this is the Home Purchase Sentiment Index. It's sitting at 82% of all buyers think it is a bad time to purchase in today's housing market. And this is the highest it's been since May of 2012, which I assume is when they started collecting this data. That means that only 18% of folks out there looking to purchase think it is a good time to buy. Are we dealing with affordability issues? Yes. Are we still dealing with high home prices? Yes, absolutely. Are we dealing with higher mortgage rates? Of course. But there is a silver lining in all this, and that is the potential home buyer in today's market, they hold a lot of the cards and a lot of the leverage. And so Now, I'm not saying this is the case in every situation, but the buyers can take a little bit more control back and hopefully negotiate a great price and a great terms. The problem is that sellers are very stubborn today. So it's probably going to take a buyer a little bit more work and effort to get into contract and get that great deal. You're going to have to get a lot of reps in order to find that diamond in the rough. And you may even have to look at properties where there's a value add component. Maybe it's not been completely renovated and there's some things you can do to actually force appreciation in the property. Now, moving on real quick to the personal story, there was a home that I looked at recently. I was interested in buying it as a primary residence and then eventually turning it into a rental property, but I could not make the numbers work. I kept an eye on what was taking place in the market. I wanted to track it and see what it ultimately closed for. Originally, it was listed at $625. A buyer came in all cash, bought it for $595. I figured it was somebody who wanted to purchase it to live in. Turns out, I was driving through the neighborhood the other day. I saw a sign in the yard and it was listed for rent. Looked it up online. They were trying to rent it for $27.50 a month. Now, I wanted to run some numbers to provide a little bit of insight as to what kind of yield this investor is getting on this property. So if you count for all of your expenses, things like property taxes, management, insurance, leasing costs, maintenance, things like that, you have annual expenses of around $11,500 with gross income at $33,000. That's assuming they actually get the $27.50 per month in rent. That'll give you a net operating income of just over $21,000. If you divide that by the original purchase price or capital deployed in the market, you would get a 3.6% yield. That's ultimately what the investor is going to take home in order to own that property. And of course, there's many other reasons to own real estate than just your cash on cash return. But the point that I want to make here is that that same amount of money could actually be parked in a high yield savings account. In fact, many of which are now offering a higher yield than that with arguably less risk. The yields start anywhere from 4.15% and even go up as high as 5%. And that is probably about as close as you could get to a risk-free return. Now, maybe this investor was doing a 1031 exchange. They had a huge tax liability, so they're trying to protect some of that. I'm not really sure, but that was just really interesting. And I had to take a step back and ask myself, is that the types of deals that we're seeing unfold here in today's housing market? Maybe it's more of a play on appreciation and long-term rent growth. I could see that being the case because it is a real tangible asset and there is a utility value associated with it as well. But anyway, that is going to wrap it up. Would love to hear your thoughts. Leave a comment below. If you're new to the channel, please hit that like button, subscribe. We'll see you next time. Thank you so much. Take care.